Hi, welcome to this video, which is about Forex price movement and order flow. Now, in terms of your beginner, you need to know how and why prices really move. And that might sound obvious, but most traders lack an understanding of the real reason prices move. And today, I want to focus on a group of traders. Now, this group of traders do a massive amount of volume in the Forex markets, and they make it their business to get retail traders, get their stops and take their money. Now, I'm not referring to Forex brokers, I'm referring to the HFTs, the high frequency traders. Now, they have an advantage of speed, they have an advantage of volume, and they're very good at using it. You have to be aware of how they operate in the market, because if you are, you'll understand better how to place your orders and more importantly actually how to place your stop losses. Now I just want to emphasize the speed and volume first, and just want you to imagine that I've got a HFT system. It's not the fastest, it's probably middling, okay? I've got $1 million so I can trade in the markets. Now, how many orders can I do in 10 microseconds, which is the time it will take you to blink your eye, and how much of volume will that equate to? The answer is coming up on a quick intro. And I'm also showing a bit of vintage footage in this intro, which is of a call out, which used to happen in my days of broking, when humans placed orders, not computers. Now, a lot of people might think that computerized trading has really made Forex trading better. Has it? I'm going to discuss why it hasn't, and why it's harder for retail traders to make money than when I first started back in the 80s. Right, here is the quick intro clip, then we'll be back to discuss.
This is Jimmy, and the bid remains 86.
I'm 86 bid for a paramedic.
I've got 20 lights flashing here, and they're all going to get the same bid.
86.
86.
Will I take 4 million?
I buy 4 million, 86.
Thank you. 2 bar here, Jimmy. And 1. Sold.
Yeah, look, I've got 3 million left to find. Yeah,
Shane did it.
2.3 seconds. Yep, going. Thank you. I buy 386. Sorry, we found our 50.
Thank you, and farewell.
Yes! Woo! Woo! Yes! Woo!
Welcome back. After that short clip, there comes some TV series Capital City. Very big when I was a brokerage. Loved that TV show. Now, in terms of what they're doing there, they're basically trying to get out of a risky position. People are brought in to help Jimmy. It's a call out. You call in anyone you need to help you, basically reduce your risk, your position, okay? Now, in terms of that way of trading, it's extremely efficient. Why? Because obviously you can see Jimmy and the guys he's with, they're very aware of the risks they've got. On the other side, the counterparties, when they're giving bids and offers, they're very aware of the risk that they've got. Everyone is aware of risk. You're very efficient in terms of pricing. Now, today with HFTs, HFT works off an algorithm, throws a big order in, liquidity on the other side might not be there. And a few times in recent years, it hasn't been there. We've actually seen the Forex markets totally break down, okay? Now that aside, I'll discuss how they did that in a moment, but that aside, they create a lot of volatility, a lot of noise, okay? And from their perspective, technicals, fundamentals, it's unimportant to most of those funds. What a good amount of those funds work on is what are other traders going to do and how can we catch them out, particularly retail traders. Retail traders now make up 12% of global Forex markets. If you consider that every 2 weeks, the Forex markets generally turn over the equivalent of the whole of global GDP. So that 12% of retail traders, it's a lot of money to be taken if you know what you're doing. And the HFTs do know what they're doing. Now, in terms of just how they operate in the markets, how to avoid them, and how to win as a retail trader, I just want to make some points on a storyboard. And I would say, yeah, if you're a retail trader, you can make money. You just got to trade in a different way and be aware of what these funds are doing in terms of price movement. Right, let's go to the storyboard and discuss some points. Right, let's have a look at how HFT funds operate. Now, obviously, it is a fairly secret part of the Forex industry. Yeah, they don't exactly advertise how they trade and the strategies they use, in specific terms. Now, in terms of my research, I do know a couple of small HFT funds where I got some information from. I've read quite a bit, in terms of background to basically how they operate in the markets. I've tried to back up what I put down here with some facts. Now, I want to take the first point here, which is the example of speed in terms of latency arbitrage. Okay, now a lot of Forex traders, when they look at the prices that they see on their computer screen, think they've got the real price. They haven't. It's delayed. Okay, now let me explain. In terms of HFT funds, they're not just a danger to retail traders, they're a danger to banks. And the example I've got here is one that was given by a guy called Kevin Rogers, who ran the FX department at Deutsche Bank up to about 10 years ago, I think. Deutsche Bank with a really big name in FX. And he would say they were just getting caught out by funds all the time, and one in particular. And he gives the example of what they did, and it just shows the mind-boggling speed of these computers. The individual bank price was 20.22. Okay, so the fund can buy at 22, and that can be seen on the electronic banking system. Okay, now when the fund actually paid the bid of 22, what Deutsche Bank constantly noticed on any bid that they did, it would instantly go up. So price jumps 23.25 bid. So they're already in profit instantly. And the bank were trying to work out how this was occurring. And they worked out that basically this fund was fantastic at latency arbitrage. What's that? Well, basically the fund scans for big orders that are going to move price on the electronic banking system. And then what it would do was instantly catch the banks that were too slow to update. So Deutsche Bank hadn't yet updated. It's caught the better price. Now, in terms of this happens just in such a short space of time. The algorithms are so quick. Okay, and the guy Kevin Rogers is saying Deutsche Bank constantly in a battle with these funds and so many other banks and institutions as well. So they can actually catch out people like Deutsche Bank. Now let's move to retail traders, because that's what we are. How do they operate? Well, they know retail traders are very transparent in general terms of what they do. Okay, now think about most retail traders, not most, but a big percentage are going to want to trade short-term moves in the day. Be day traders, be scalpers, scalping off the minute chart, 30-minute chart, or whatever it might be. That's the kill zone. HFTs have a field day there. Someone I know said it was like the HFTs are combine harvesters in a field, just going through, mopping up the cabbages and taking them home. By the cabbages, obviously, the retail trader. I've said it before. Do not try and day trade consistently or scalp small moves. These guys are quicker. They've got the price quicker. They've got heavy funds that can push the price around to levels that they know short-term traders are looking at and just take them. Okay. So you should always avoid day trading and scalping. I'm not saying you can't do a trade in a day, but you can't do it consistently every day like a lot of traders think. It's just one of the sort of nonsense you see in a huge amount of YouTube videos, for example, maybe $1,000 a day consistently or a week or whatever it is. It's just total myth. You can't do it. HFTs will definitely get you. And also, there's a lot of market noise anyway without the HFTs. They identify stop clusters, no question about that. Niederhoff was one of the first people ever to do this back in the 1990s. He had a fairly fast system. And what he would do was he would work on the principle that when prices reach a round number, let's say 162 in GBP USD, there will be orders sitting right on that round number. And obviously it can go either way. The system would take a view one way and immediately firewall itself in the spread because it's so quick, okay? If the price runs in its favour, it's going to make a good profit. If it comes back, it's a negligible loss. I made hundreds of millions of dollars doing that, and George Soros even gave him money. But yeah, eventually other funds caught on to what he was doing. Today, HFTs are probably a little bit more sophisticated in everything which they do. But one of the things that I'd say to any new trader coming in the markets, never ever place your order on a round number, be it a stop or an entry order. It's just such a, in my view, bad thing to do because it's vulnerable to being getting hit. What you normally have is that battle around round numbers. So, for example, when I'm doing my charts in the member centre, I will never enter near a round number as a general rule. It normally be, depending on the pair, 20 pips either side for a stop or an entry order, sometimes 30, 35. I just want to get that round number in the battle out of the way. Now, hitting the retail trader bias and their lack of staying power. Well, we know most retail traders are over leveraged. They lack staying power. And most do what I would consider to be obvious things. And this brings me to an example, which is trading news. An example here I've got is non-farm payroll. Someone knows that was feeding day for the sharks. And I find it quite amusing, actually. You probably had this yourself. You get in your inbox, come to our non-farm payroll webinar, trade it with us. And they normally say things like this, right? The expected number of jobs added is 200k. So if it's like 300k, probably going up. If it's 100k, it's probably going down. And then they trade in that manner. Now, a HFT, as soon as that number is released, okay, it's got it before you can do anything. And it's already done some orders probably. And a lot of HFTs, I'm sure they do this, is let's say you've got a bullish headline number. They'll be in and buy. The retail trader will come in with them. They'll run the price up. Then they'll slap it down to grab the retail trader's stop. You see it a lot, breakouts of levels that suddenly, they break out quite nicely and then they suddenly become fake outs because they've been slapped by HFT funds. Okay. And it happens all the time. They will target obvious support and resistance levels. There's many HTs that basically work out what the retail trader bias is, and then basically try and make money from that bias. Now, in terms of what I got next, bear tranquilizer and the dangers of rogue orders. The bear tranquilizer that comes again from Kevin Rogers when he was talking to a guy in an FX department, or the FX department, and he had this big red kind of lever thing at the side of his desk. Rogers said, well, what's that? And he goes, well, that will shut down every electronic system that we've got if it goes rogue and does something stupid. It's a bit like the bear gets out the zoo, got to shoot him with the tranquilizer before he can do damage. But the problem is, yeah, HFT systems and banks, they do have these shutdowns, okay, but it doesn't always happen. I've given the example here of Knight Capital 2011. They did 4 million, or their algos did 4 million rogue executions or orders. So 397 million deals. It was in a 45-minute period, and it collapsed the company. Now, that was actually in shares, okay, but it happens in Forex as well. Think back to the cable flash crash. And there's a lot of debate about what that was. You know, was it a fat finger trade where a dealer made a mistake? No dealer is going to make that mistake, a human, but a computer can. And that's probably what it was. You saw cable drop 10% in a matter of minutes. And you've got to think about this. GBP USD, you got the largest economy in the world and the 5th largest, and the currency drops 10% on no news whatsoever. Nothing had come out to affect the price, really. They did an investigation, the Bank of England. They didn't come to any specific conclusion about what had happened. It was a rogue HFT, in my view. Also, the problem you've got, markets heavily leveraged, computers doing everything, and when a big event does come, there can be a total breakdown of the electronic banking system, which happened when the Swiss National Bank removed their stabilisation of the franc with the euro. You just saw massive move. No prices were being quoted for a period of time. No liquidity. That wouldn't happen with humans, okay? So I think, yeah, you do have in the markets today, yeah, these speed traders, they can cause a lot of volatility. They're causing a lot of problems. I think generally the way, you know, everything is computerized today. I mean, computers are wonderful things, but yeah, mistakes can be made by them. And yeah, I've just given a few. And yeah, a lot of the back offices now are computerized and orders are computerized. It's a very fragile financial system, not just in Forex, which Nassim Taleb, one of my favourite authors, is really concerned about, and it is a major concern. Now, in terms of the HFTs, should they be a worry to you? My answer is no. Okay, you just got to act in the right way in the markets and stay out of the way of them. You don't day trade, you don't scalp consistently, you don't put your orders in obvious places, and you work out the obvious. Yeah, if it's an obvious breakout, it's probably going to be obviously wrong, okay? You know, I think there's sort of general points for any beginner. You know, no short-term trading, don't do obvious things. Be very careful about where you place your entry. Also be very careful about where you place your stop. That's so important. Don't trade regularly, okay? And by that I mean be very selective about your trades. Focus more on catching longer term moves. The HFTs are really most influential in the short term. In the long term, they can't keep prices going the way they want forever. I mean, it's in short bursts, it's in short time periods, okay? So if you're trading longer term, that is a good thing. Also, keep your leverage down, okay, so you can have enough distance to your stop and still have enough profit potential on the other side. I think that's just about everything I was going to say. I hope you enjoyed my little summary of HFT trading. And it's something that most beginners don't think about. These guys know what they're doing. You want to stay out of the way of them. You cannot compete with them unless you've got a lot of money, a lot of great computer programmers and so forth. But we can make money, just we need to do it in a different way. Right, that's the video for today. Thanks for watching me as usual. Take care. Have a good day.